In the last few videos, we've looked at internal range liquidity, taking entries from points within that internal range liquidity, like order blocks, fair value gaps, sometimes breaker blocks, towards high probability targets. But what if I told you there is a potentially simpler way to just get involved in your trade that is 100% mechanical? It's not going to be for everyone, but if you're short on time and you want just a simpler way to enter trades, this could be the solution. So let's just start with a quick definition. What is premium and discount? So in any given range of price, whether that's a candle range, a price leg, we can split the range in two. We have the expensive part of the range and the cheap part of the range, otherwise known as premium and discount. Ideally, we prefer to trade from discount because one, we're getting a better price, and two, we're probably going to get a higher risk to reward. So this is premium and discount visualized. So we have our price leg in this instance. So from this point to this point, this is our swing low, swing high. Order block, we have a fair value gap in here. So we've looked at this in the last few videos. But what we can also do is mark the high and low of the range and split it in two. What this now becomes in a bullish price range is an area of premium price, the upper 50% of the range, the expensive part of the range, and the discounted part of the range, the lower 50%. And it's as simple as if price is going to fill internal range liquidity in this area, then the logic is we want to get involved from the cheaper half of the range. Now in this example, you don't get tagged at the 50%, and that's okay. But sometimes we're going to go deep or just tag 50%. You get your entry and you are in the trade. You don't have to think about, am I buying from a fair value gap, an order block, a breaker block? You're just either in or you're out. So what to look for? Premium and discount for your higher time frame candle ranges, particularly manipulation ranges. Secondly, premium and discount for your lower time frame price legs. This is the big one because this is where you're going to be executing. And as always, context towards higher time frame targets. If you haven't followed or watched series 1, check it out because that's where we talk about where price is targeting. So let's jump onto the chart and just look at some quick examples. So the first thing I want to just show you is this expansion. So what we covered earlier in the series is the fact that this price range here printed bullish, this monthly candle. So if you're just joining, we're looking at 12-hour price action. We're swing trading. So we're looking at monthly, 2-weekly, and weekly trade ideas. So as we're making this expansion and then we retrace, we have context that the monthly is moving higher. So we can bring up the 2-week time frame, and what we get is price expanding and closing above a previous candle range. So when we start to see price retrace, we can anticipate that price is going to first target the high because there's been no manipulation to signal a reversal at this point. Now, if we just take this entire 2-week candle, we can mark that as a range. The way we do this is we use fib retracement levels. So we mark the high of the range and drag down to the low of the range. And what you see here is I have a 50% marker. So this is our discount below the 50%. This is our premium above the 50%. And what does price do? So it retraces, finds support at the 50%, then trades to the high. You also have an order block right here. So there's an argument that you could take a bullish trade by simply using this discount level entry covering the lows to the high. This is just using the logic of candle ranges and premium and discount. What does that give you? It gives you a 1.82 trade that you can hold for a 2R. So what then happens is we get a manipulation candle. So price manipulates and closes inside the previous candle range. We also know that this is a monthly liquidation, which we covered earlier in the series. So again, we can start to use our fib levels. So we just drag from the low to the high, and there's our 50%. So in this example, just using the candle range here, we would not get tagged. But what else do we know? This is also a price leg. So we can drag this down to cover the entire price leg. Where does price retrace to? The 50%, almost exactly. We also have a breaker block. So again, you have a potential area that price is going to react from. It's the discount of the range, this price leg. Again, we now have manipulation closing inside previous candle range. So this candle then closes below the previous candle range. So again, what can we do? We can mark the low, drag back to the high, and where does price in this candle react from? Trades into the discounted half of the range and continues lower. So again, we're catching potentially that expansion lower into this manipulation. So I would always advise you to map the ranges on the higher time frame that you are trading, because this can give you high probability areas that price is going to react from in the event that it's going to continue towards those high probability targets. The next step is then using the exact same logic when looking at our price legs. So when we see that price breaks below this low right here, and we see the creation of this bullish price leg, let's imagine that we're looking now at the fact that we've manipulated this level and we're going to now target the opposing end of the 2-week candle right here. Soon as we get this bullish price action, we get an order block here, which price does mitigate. So the last sell to buy. We also get a bullish fair value gap, which I can just mark to make explicit right here. So we can mark that in green. So you see price liquidates the low, shifts, new order flow bullish, bullish fair value gap, bullish demand zone. Price then trades down into the demand zone and eventually takes off to the higher time frame target once we get the confirmation of this manipulation candle. Okay, we can set our order at the fair value gap, we can set our order at the order block, but even easier, we can just mark the high, drag to the low, and simply set our order at the 50%. Cover the low, target the high, 2.58R. So it gives you a very simple mechanical way to, one, visualize where price might react from when looking at higher time frame candle ranges, and two, actually execute within the price legs that aim towards your higher time frame targets. This will not always play out. So there are times that price will just tag the fair value gap and take off without you. It doesn't need to mitigate the discount of the range. So again, there are trade-offs here. You will have a more mechanical entry strategy, but you may leave one, R's on the table because you're missing order block entries, or you don't get tagged because the fair value gap sits in the premium of the range and price takes off without you. So it's another consideration, but it does make things extremely easy and mechanical when you're thinking about entries. So that's how to use premium and discount, and that's how to think about premium and discount. Now we're going to look at true structure shifts in the market. See you on the next.